Most people think the danger begins when the dollar finally breaks. I think the danger begins much earlier, when the dollar still looks strong enough to trust, but no longer strong enough to carry your entire future by itself. That is the trap. The average American investor thinks he owns diversification because he owns an index fund, a retirement account, and a few household name companies. In reality, many of them own one giant concentrated bet. One country, one currency regime, one market structure, one group of enormous companies that have already absorbed most of the easy capital. That was a wonderful trade for a long time. It is not a free trade anymore. When an empire really starts to lose altitude, it does not usually collapse like a building in an earthquake. It leaks like a fuel line in the dark, quietly, gradually, invisibly at first. The pilot still thinks the plane is flying fine because the cabin looks calm. The passengers are still ordering drinks, but the range is shrinking, the margin is shrinking. The future that used to come automatically now has to be earned. That is where we are. I am not here to tell you the United States is finished. I do not believe that. I am here to tell you something more dangerous than that. I am here to tell you that the era of effortless U.S. only dominance is being diluted, and most people are still managing their money as if nothing important has changed. That is how wealth gets hurt. Not by one dramatic event, by staying loyal to an old map after the terrain has already moved. I want you to hold one idea in your head all the way through this conversation. The biggest risk in the next decade is not that America disappears. The biggest risk is that America remains powerful enough to keep you comfortable, but not dominant enough to keep your portfolio easy. That is a very different problem. Easy money creates lazy assumptions create concentrated portfolios. Concentrated portfolios create unpleasant surprises the moment the world stops paying the same premium for your home market, your home currency, and your favorite giant companies. I have seen versions of this movie before. The faces change. The flags change. The slogans change. The mechanism does not. A nation rises, its currency becomes the center of trade, its assets become the default destination for global savings, its people begin to confuse privilege with inevitability. Then the leakage starts, not because the center vanishes overnight, but because the rest of the world slowly learns how to route around it. That is the mother line here. Not collapse, circumvention, not death, dilution, not panic, repricing. If you understand that, the next decade stops looking like a riddle and starts looking like a capital allocation problem. The first mechanism is what I call privilege decay. For decades, America enjoyed a beautiful arrangement. The dollar sat at the center of the system. Countries needed it for trade, for reserves, for commodities, for debt settlement, for safety, for liquidity, for access. That gave the United States an extraordinary advantage. We could borrow more cheaply, we could run bigger deficits, we could print more aggressively than most countries without suffering the same immediate penalty. Global demand for dollars absorbed a lot of behavior that would have broken smaller systems. That privilege is not gone, but it is no longer unquestioned. And when privilege stops being unquestioned, the compounding math changes. A lot of investors hear de-dollarization and imagine one clean day when the world wakes up and abandons the dollar. That is childish thinking. Systems this large do not turn off like a light switch. They erode through share loss, a little less reserve demand, a little less trade settlement, a little more bilateral invoicing, a little more gold, a little more regional plumbing, a little more willingness to hold something other than treasuries at the margin. That margin matters. The dollar does not need to go to zero for your future returns to get worse. It only needs to stop monopolizing global trust the way it did before. That is privilege decay. It is the difference between being the only superpower and being merely the largest one. That sounds small. It is not small because markets price the difference. The second mechanism is reserve leakage. This is where most people make the same mistake. They say, fine, the dollar's share may be down a little, but it is still the reserve currency. That is true. It is also incomplete. When a dominant asset falls from overwhelming to merely leading, the psychological shift arrives before the statistical endpoint. That is what people miss. A reserve system is not just built on current usage. It is built on future expectation. When central banks, sovereign funds, and large institutions start acting as though they need alternatives, the habit changes before the headline changes. You have already seen that behavior. Central banks have been accumulating gold at an aggressive pace because gold has one quality politicians hate and serious states respect. It is outside the liabilities of another government. It cannot be printed by a rival. It cannot be sanctioned by decree. It cannot be diluted by a legislature that has fallen in love with deficits. Gold does not replace the dollar. It weakens the assumption that the dollar must remain the only answer. That is enough to matter. China has also been reducing its reliance on U.S. Treasury exposure over time. Not to make a theatrical statement, to reduce vulnerability, to diversify options, to build room. Other countries have drawn the same lesson after watching reserves become a weapon in geopolitical conflict. Once you teach the world that reserve assets can become political pressure points, the world starts asking for escape routes. That is reserve leakage. It does not announce itself with sirens. It shows up in allocation committees. It shows up in payment experiments. It shows up in treasury auctions at the margin. It shows up in gold vaults. It shows up in the quiet sentence every finance ministry eventually whispers to itself. We need a second door. The third mechanism is payment escape. This one is even more important because global power is not just about what people hold. It is about how they transact. If countries can invoice trade, settle trade, and the network effect starts to weaken even without a full replacement currency. That is the key. The world is not waiting for one perfect anti-dollar alternative. The world is building many imperfect workarounds. Some of them are bilateral trade deals settled in local currencies. Some are regional payment rails. Some are cross-border systems designed to reduce dependence on Western-controlled infrastructure. Some are experiments in digital settlement. Some are commodity-linked ideas. Some will fail. Some will remain niche. But the strategic value does not come from perfection. It comes from optionality. Once optionality exists, monopoly power starts to soften. I would not overdramatize any one project. I would not pretend one flashy acronym ends the old system. That is media thinking. I care about direction. Direction is what makes money over long stretches. And direction here is obvious. More countries want at least partial independence from a payment architecture they do not fully control. That means the old architecture does not disappear. It means it loses exclusivity. Payment escape is dangerous because it changes the future demand curve for the dollar without needing a revolution. A modest reduction in forced dollar usage over time is enough to change currency pressure, capital flows, and valuation logic. Again, you do not need collapse, you need leakage. The fourth mechanism is what I call the home country trap. This is where the average investor gets hurt. An American feels diversified because he owns 500 companies through an index fund. But look closer. A huge percentage of his money is still tied to one legal system, one tax base, one currency, and one style of corporate concentration. And the concentration has gotten extreme. A handful of giant companies now drive an outsized share of the index that work beautifully while scale, passive flows, low rates, and U.S. exceptionalism all reinforced one another. But what happens when the same companies are no longer cheap, no longer undisputed, and no longer enough by themselves to carry the whole market at the old speed? Returns compress. Volatility feels more concentrated. Diversification turns out to have been costume jewelry. That is the home country trap. The American investor tells himself, I own the world because U.S. companies sell to the world. Sometimes that is partly true, but revenue exposure is not the same as valuation diversification. Currency exposure is not the same as country exposure. Owning expensive domestic giants with global customers is not the same thing as owning a genuinely broader opportunity set at more reasonable prices, and valuation matters. You do not get paid for patriotism in the stock market. You get paid for cash flows purchased at sensible prices. If U.S. markets start the next decade from richer valuations and the rest of the world starts from lower expectations, the arithmetic begins to favor areas most American portfolios barely touch. That does not mean abandon the United States. It means stop treating one country as if it were the whole investable universe. The fifth mechanism is the commodity floor. Whenever a dominant currency weakens at the margin, real assets start speaking louder. Not because every commodity becomes a magical investment, because the world still needs to eat, build, wire, transport, cool, and power itself. Copper does not care about ideology. Energy does not care about slogans. Industrial inputs do not disappear because a central bank wrote a speech. If emerging markets continue growing, if infrastructure build, outs continue if energy security remains a geopolitical obsession. If supply chains keep becoming strategic rather than purely economic, then the assets tied to physical necessity carry a different kind of value. They become insurance against a world where paper claims are more political and real inputs are more scarce. Now be careful here, I am not telling you to become a commodity speculator. I do not like building long-term lives around cyclical excitement. Oil goes up, oil comes down, metals spike, metals collapse. Traders love that. Most families do not need that as their core strategy. But I do want you to understand the principle in a world. Order transition, commodity exposure is not just a bet on price. It is a hedge against monetary dilution, geopolitical friction, and the physical needs of industrial growth that matters. The sixth mechanism is the second engine principle. This is the one I care about most for portfolio construction. If America remains powerful but no longer singular, then the winning portfolio of the next decade probably needs a second engine. Not an escape hatch, not an anti-American tantrum, a second engine. A part of the portfolio that benefits if global growth broadens, a part that benefits if international valuations re-rate, a part that benefits if emerging consumers, emerging businesses, and emerging infrastructure keep taking a larger share of the world economy. A part that benefits if the dollar weakens modestly over long periods rather than remaining permanently supreme. Most people do not build second engines because they are in love with familiarity. Familiarity feels safe. Familiarity also produces under-diversification, dressed as I would rather own a structure than a slogan. I would rather own something that wins in more than one version of the future. That means I still want high-quality U.S. businesses. America still has extraordinary strengths. The deepest capital markets, serious rule, of-law advantages relative to much of the world, massive innovation in artificial intelligence, semiconductors, software, and capital formation. In a true panic, capital still runs toward the United States. Because scale and liquidity matter, I am not shorting that. I am not betting against that. What I am refusing to do is assume that those strengths alone guarantee the same dominance premium they gave us for the last generation. That is the whole point. You do not need to go from all in America to anti-America. You need to go from one engine to two. This is where people usually ask me the wrong question. They ask, so what replaces the dollar? I think that is a bad question. The better question is, what gains value when the world becomes more multipolar, more diversified, and less willing to concentrate trust in one place? That question produces better answers. Some of those answers are international equities bought through broad, low-cost vehicles. Some are emerging market exposures with more runway and lower starting expectations. Some are selective real asset hedges. Some are gold as monetary insurance. Some are commodity linked exposure. Some are world-class companies with durable economics that can keep compounding even if the country premium softens. The point is not to predict one winner. The point is to stop pretending the old one has no challengers. Let me make this practical. If you are sitting in a portfolio that is overwhelmingly U.S., large cap, overwhelmingly dollar, denominated, and almost entirely dependent on the same handful of giant companies continuing to absorb the world's savings, then you are not diversified. You are comfortable. Those are not the same thing. Comfort is a mood. Diversification is a structure, and structure is what protects you when moods change. I would begin with a blunt inventory. How much of your net worth depends on the dollar remaining structurally stronger than almost every rival for another 20 years? How much depends on U.S. equities remaining the best house in the neighborhood every single year? How much depends on a tiny slice of mega cap companies carrying both your retirement and your optimism? How much of your portfolio would benefit if India grows faster than expected? How much would benefit if emerging market valuations re-rate? How much would benefit if central banks keep buying gold? How much would benefit if commodities become more important in a fractured world? If the answer to those last four questions is almost nothing, then you have built a one country, one currency, one regime portfolio for a world that is becoming less singular every year. That is not smart. That is lazy. There is another danger here, and it is psychological. Americans have been trained by experience to believe every international allocation is optional, every dip is temporary, every foreign opportunity is inferior, and every big institutional shift takes too long to matter. That conditioning was understandable. It was also profitable. It may now be expensive, because the real pain in world order transitions does not come from one giant wrong bet. It comes from 10 years of mild underperformance caused by a refusal to notice that the center of gravity is widening. Widening is enough. A lower dollar, better foreign valuations, faster emerging, market growth, heavier commodity demand, central bank diversification, fatter non-US opportunity sets. That combination does not need to be spectacular in any one year. Over 10 to 15 years, it can completely change relative wealth outcomes. And relative outcomes are what matter. You do not retire on headlines, you retire on compounding. I learned a long time ago that the stock market has a brutal sense of humor. It keeps rewarding what worked until people start believing it can only work. Then it makes those people pay tuition. The tuition ahead will likely be paid by investors who think the old map is still enough. They will keep buying the same concentrated U.S. index exposure. They will keep dismissing international assets as clutter. They will keep ignoring real assets as old-fashioned. They will keep pretending currency does not matter. They will keep assuming valuation does not matter, because the last decade made expensive things look intelligent. Then one day they will look up and discover they were not blown up. They were slowly outgrown. That is the future I want you to avoid. So here is the protocol. First, stop asking whether the dollar dies and start asking whether its dominance premium shrinks. That is the real question. It is already the more relevant one. Second, stop building a portfolio around a single empire's continued perfection. Nothing in history earns that kind of blind loyalty. Third, keep your U.S. core, but strip it of its religious status. Great assets should be owned. They should not be worshipped. Fourth, build a second engine. Broad international exposure, thoughtful emerging, market exposure, sensible real asset exposure, monetary insurance that does not depend on politicians behaving. Fifth, understand that diversification is not a confession of weakness. It is an admission of reality. 6. Stop waiting for the official obituary of the old order. By the time everyone agrees the world changed, the repricing will already be behind you. That is how markets work. The big money does not wait for unanimous clarity. It moves when the probability curve starts bending, and the curve is bending. Now I will leave you with the most important thought in this entire piece. History does not punish people for failing to predict every event. It punishes them for staying concentrated in yesterday's certainty after the certainty has already started leaking. That is where we are. The dollar still matters enormously. America still matters enormously. U.S. businesses still matter enormously. But still matters is not the same as only answer. The world is not getting smaller. It is getting wider. And the investor who understands that early will not just protect his money. He will buy the next decade at a better price than the man who kept all his faith in the last one. There is one more mistake I want to rip out of your head before you move another dollar. A lot of people hear this argument and immediately swing to a false binary. They say either the dollar remains untouchable or the dollar loses everything. Either America stays number one forever or America becomes uninvestable. Either you stay all domestic or you run to foreign markets as if they were automatically safer. That is foolish. Transitions are where nuance makes money. The dollar can remain the reserve leader and still deliver weaker strategic support for a one-country portfolio. The United States can remain the innovation center and still produce lower market returns than cheaper foreign markets, starting from better valuations. China can grow larger in some aggregate sense and still remain problematic as a place to commit blind trust, because capital controls, political intervention, and governance risk are real things, not academic footnotes. India can become more important without becoming simple. Europe can remain fragmented and still offer pockets of excellent value. Gold can be useful without becoming a religion. Commodities can matter without becoming a lifestyle. That is how adults invest. Not with slogans, with ranges, with probabilities, with structures. That is also why I do not want you to build this portfolio around one dramatic anti-dollar trade. I want you to build it around a more durable truth. When the old center becomes less absolute, the value of optionality goes up. That is the whole game. Optionality in geography, optionality in currency exposure, optionality in real assets, optionality in sources of earnings growth, optionality in political outcomes. The family that owns only one kind of future is the family that gets hurt when history chooses a different one. And history enjoys choosing different ones. I also want to say something about India, because people keep looking for one headline substitute for America. and that is not how real capital shifts work. It matters because it represents a young, expanding, increasingly formalizing economic engine entering a world where capital is beginning to search harder for growth outside the old center. Demographics matter. Digital adoption matters. Productivity catch-up matters. Domestic consumption matters. A lower starting point matters. None of that guarantees great returns, but it creates a different type of runway than the one most expensive mature markets can offer. That is what intelligent diversification looks like. You do not buy a dream, you buy a favorable setup. The same principle applies to emerging markets more broadly. They are not automatically superior. Many of them are messy. Governance can be weaker, currency risk can be ugly, political shocks can be sharper, but messiness is often the toll you pay to buy growth before it gets polished and fully repriced. The right answer is not to avoid them because they are volatile. The right answer is to size them correctly, own them intelligently, and refuse to confuse volatility with worthlessness. If you remember nothing else, remember this. The old world order trained you to think in categories that were too comfortable. U.S. versus foreign, stocks versus gold, safety versus risk. The next decade will reward a different mindset. Structure versus concentration, optionality versus nostalgia, price versus real assets versus paper complacency, multipolar exposure versus home country sleepwalking. That is the shift. And that shift is why I keep coming back to the same hard sentence. You are not being asked to predict the winner of a geopolitical cage match. You are being asked to stop leaving your family's future tied to one political promise, one reserve regime, one valuation extreme, and one historical memory. That is a much simpler task. You do not need genius for that. You need honesty about where your risk actually lives. Honesty about how much of your confidence has been borrowed from the last cycle. Honesty about the fact that a portfolio built for a one-pole world may not be good enough for a multi-pole one. That is why this opportunity is so large. Because most people will not do the honest inventory. They will wait for television to grant permission. They will wait for a formal declaration that the old order is weakening. They will wait for a dramatic collapse that may never come. And while they wait, capital will keep doing what capital always does. It will move first, it will move quietly, and it will reward the people who understood that slow leaks can reshape an empire just as effectively as explosions.